said this morning would be different, so it is different. We've got a case study for the these speakers or panel, and the case study will be. Will it be up on the? I don't know. Anyway, I'm going to read it. If anyone wants a copy, my copier went stupid last night, so I've got them on both sides the same thing, which isn't very helpful. But we can send you copies of everything if you want it after the event. So I'll just read you the case study. Hazza and Megzi have been married for 20 years and have a chain of businesses, some of which are franchised. They had been going really well until a year before COVID, when everything slowed down. They'd been struggling ever since, and COVID was just the final straw. They have the following problems and don't know what to do. There are 2 major government contracts which should result in receipts of $500,000, but the government is slow to pay. If the government paid, they could clear most of the debts. The staff super debt is now over $100,000. There's a GST debt of $50,000, and there's an income tax debt of $150,000, and they haven't paid the tax for their staff of $120,000. They did have a payment arrangement with the ATO, but this has recently defaulted, and they owe other suppliers $95,000. Some of the suppliers are now demanding cash and won't extend further credit. Hazza and Megzi have each received a director's penalty notice. They don't know what it means, but they know they need to do something in a hurry. They're concerned that they won't be able to pay their staff this week. The bank won't help, and they're too scared to ring the ATO. They're worried they might lose their house. Their accountant has pointed out some errors in their GST calculations, which would reduce the debt, but they're worried about how much this might cost them for someone to actually prepare the documentation. And they're worried that if they can't afford to pay the staff and some of them leave, their business won't be viable. Now, I don't know if any of that sounds like any of you. I'm sure it doesn't, but if it does, we've got a panel here who can help with some questions. Now, what I'm planning to do, just so as to make it clear, I have some questions, but I want questions from the floor as well. So what I'm proposing is I'm going to ask the first question. As discussion moves on, if you have a burning question that comes out of something that's said, or even if you've got a burning question that hasn't been said, put your hand up, and Amy over there will come around and with a mic, and so everyone. Oh, sorry, it's Wayne up there. I beg your pardon. Plan change. And Peter over there. All right, try again. So Wayne and Peter will come around with the mics, and they're ready, waiting to answer your questions, so everyone can hear you. That's all. Okay. So the first question, this is a very general question I'm going to ask the panel. When is it time to call it and close down the business versus trying to restructure and keep going? So I think I'm going to start at that end with Aaron. And now, if you're having trouble with the mic, it should be on, and you just have to move it a little bit to speak. If you've got a problem, someone will run down and show you what to do, I'm sure, but I don't know who at the moment.
Right.
Okay.
Thanks, Gail. I'm not sure the mic's working.
Push it up.
Push it. Is that better?
That's closer.
How about that? Yep. Yep. Is that better?
Right. Fantastic.
Thanks, Gail. Yeah, I think at a high level, this is a question that we're quite commonly asked, is when do I try to restructure my business, and when do I decide it's time to shut the business down? And I think as a point in time decision, you have to look sort of at the structure of the debt of the business, and whether that is a long-term residual debt that's accrued over a number of years because the business hasn't been profitable for one reason or another, and you've used the debt as a means to manage cash flow, or whether or not it's a one-off or a short period, as an example of the case study where things were going well and then COVID caused an issue where profitability drops off, but the underlying business itself is still quite good. And I think once you have that in hand and you make an analysis of that, you have to look at what the cost of a restructure is versus a close down. And I think as a small business owner, to make some significant changes to your cost structure in order to improve your profitability means that you as an individual might make a lot less money in the business. You might have to take on some more debt to fund short-term cash flow and working capital. So I think there's a cost analysis that needs to be done, and a general cost to restructure a business. So I think you have to look at the historical factors and whether or not you can afford to restructure going forward.
Any other comments?
I guess I'd probably take a more preliminary view than Aaron at the outset. For me, that question is answered by, the Hazes and Megsies of the world. It's a preliminary conversation that says, where are you at emotionally? Where are you at in terms of your willingness to fight to pull this out of the muck? All of us can put together a plan, but a plan is only as good as your ability to execute it. So if you're not in the right headspace, if you don't have the emotional energy, the physical energy, because let's face it, business challenges take a toll on your physical health as well. And if you don't have some financial resources behind you, it makes it very difficult to overcome that initial hurdle. So the preliminary conversation for me is always with directors and individuals, where are you at in this process? And look, some of them unfortunately say, stick a fork in me, I'm done. I don't want to go through that process. I am just sick and tired of being sick and tired. And unfortunately, I think we've all seen businesses that are potential, or they have the potential to be saved, or there's merit in saving them, but the operators of the business simply aren't in it any longer. And that's a challenge for us as practitioners, because we like to try and generate good outcomes. But I think in instances like this, it's always down to the individuals. If they're not committed to the plan, then none of us can execute it for them.
Yep.
Yeah, I agree with Tony, because I think the first question we asked to the directors is, for us, a close down is probably the simple job really for us, is to close down a business, because you can easily make the steps to stop activity. But if a director comes in or the debtor comes in and say, I want to survive, the business has got oxygen, then as a practitioner and a business advisor, we've got to work out steps how to keep the business alive. So that's probably a difficult job for us in a way, that we've got to start thinking about, okay, given the challenges that the business has, how do we do it? So the motivation of the director and the debtor is really fundamental for us going forward. Normally I say it's 90% of the solution. If they come in, they're motivated to go ahead, then more likely than ever, the business will survive.
I feel like I should say something.
Please do.
I have to say something. I think what the boys are, I know this is what the boys also do, but as a lawyer, I have to confess, I come in, I tend to come in later. People don't typically come to their lawyer when they are in financial distress. They go to their accountant, and we work together. But one of the other things that we look at is eyes wide open. If you're in financial distress, what are your options? And that includes what are the potential follow-ons. So if you go into there are particular types of external administration. So you could have an administrator. What does that mean? Well, that means that, for example, your personal guarantees and some other things are just parked while the external administrator works out what might be done in your business. If you go to liquidation, then they're alive and going. I counsel clients to think about broader things like reputation. They may or may not be concerned about that, but if they have other businesses that are alive and going, what might an external administration look like in that trading space? relationships with financiers. But I think what we're all leading to is that when somebody comes in for advice, that's great, that's really good that we can get the conversation going, but there's not an immediate and one-size-fits-all solution. It does take some thinking, some clever minds to work with the best, the people who know the business best, being the owners, about where to from here.
Thank you. Okay, no questions? All right, well, I'll move on to another thing that I've been asked. So what are the advantages and pitfalls of using low doc? If you all don't know what low doc are, low documents. So when you go to the bank, you normally have to produce a sheet of documents like this. When you go to some of these other lenders, you just fill in things online. They don't require documentary evidence. They charge you more. And so the question is, what are the advantages and pitfalls of using low doc, short-term cash flow loans? I don't know if anyone wants to jump in. Thank you.
That one too. Yep. Can you hear me?
Yep.
Okay. I guess I will just give a couple examples of where it's worked in my experience and where it hasn't worked. I had a client that was a cable tray manufacturer who had a really good product. It was taking off in the building industry, had some good commercial building clients as far as placing orders go, but were horrible at paying. And we were able to introduce them to what's called a debt factor, where you sell your invoices to somebody up front for a percentage of money. They collect the invoice and then they give you the residual balance net of their fees. And that gave them a really good steady cash flow boost that was really well managed, allowed them to scale up a bit, improve their profitability, improve their working capital, and they're still going today, and that was 5 years ago. So that was a really successful way to manage cash flow through short-term lending. The opposite end of that scale is, something I'm dealing with now, who is a cafe owner who tried to get through COVID by going online, like Gail said, filling out many forms. He's gotten loans from guys like BizCap and Lendy and Save Your Bacon sort of people. And of course, he's personally guaranteed these. He's provided, security over his personal property, which he didn't really understand. He's provided security over his boat, which he didn't really understand he was doing. Obviously, his cafe's gone under because it's in a location that's dependent on office workers, and people in that area aren't going back to work. So he's now in a situation where the business has gone into liquidation, and he's looking at $100,000 of prime debt with exorbitant default and interest rates. So I think the advantages of that is if you take some good advice and go with a reputable financier, it works well. But if you're just hunting for cash without taking proper advice, without looking at your records, and without understanding what sort of deal you're entering into, you can get into some serious trouble.
I think I'd add to that by saying, understand what you're buying before you buy it. And this is where Bernice comes in handy. I won't say her advice is invaluable here. It doesn't cost you a lot to have a lawyer run their eyes over the fine print of one of these very attractive sales contracts to understand what the downside risk is. So one of those great, some of you in the room will remember the departed investor, Rene Rivkin, and his motto was always evaluate the downside risk first before you make any investment decision. And this is an investment decision. You're investing or reinvesting in your business by using somebody else's money. Now they're going to sell it to you on the basis that is super attractive. They won't mention what the interest rates are because they're always at a premium over mortgage and usual lending rates. And they will say, this is what you need, this is going to help you, this will get you back on your feet. But using Aaron's example of invoice factoring, it's very attractive on the way in because you get your money up front. If anybody in the room's ever tried to get out of a factoring arrangement, it's expensive because you've got to meet the shortfall on the difference between your invoice values and the lender's exposure. So you need extra cash flow to get out. And so some of these things end up being the financial Hotel California. You can check out whenever you like, you just can't leave. So when you're doing these things, it's really important that you understand what it is that you're buying. And that's not to say the products are bad, but they're going to be sold to you in a particular way that makes them super attractive from the seller's point of view. And they're in it for a profit as well. So understand that they're not a charity. They're not coming to you saying, oh, we understand your situation, here's some free money. There's always a cost to it. And as Aaron said, it's about buying the right product for your needs at that particular time. And it may change. And there's not to say that you can't get out of it, but it is really important just to get that understanding. And if it's not you that can work your way through all the fine print, lean on someone who can, because it's too late to have regrets once you're into these arrangements. And we see buyer's remorse all the time. I wish I had, fill in the blanks.
The example that I had where they borrowed money, say from Prosper, say as a no document, they signed the document. What in the agreement they had a caveat on their residential property. So unbeknown to them, so when the company went into liquidation, there was probably about 80 grand owing to Prosper. But because they had that clause, they had a caveat. They could appoint a receiver to their house. So really, you have to resolve the issue. Otherwise, it wasn't come to terms with that. Paying that 80,000 or so, then they had security over the house. So you've got to really be careful what you sign, because sometimes you just look at the 80 grand that you're going to get straight away, but you don't look at the unknown, which Tony and Bernice and Aaron sort of indicated.
Have you got comments, Bernice?
No, should I make some comments?
We want to hear from the lawyers. We like lawyers.
I'm just conscious we don't want to give you all doom and gloom. There are options. Some of those arrangements, as Aaron said, can be helpful. What I'd say is, echoing Frank, make sure you read that document. I've never been able to undo a guarantee or a caveat that's attaching to them. The days of, I don't know, remember there were the unconscionable conduct cases that ran through in the 80s, Amadio and, parties of different bargaining. The lenders have wised up, and they don't fall into that trap anymore. They've got all the boxes about you getting independent advice and you know what you're doing and that sort of thing. So, and that has just been heartbreaking in my experience to have clients saying, but I want out, and you go, but your house is caveated and we can't get that off until you pay some money or the guarantee. So again, it's back to that eyes wide open scenario.
I know it's not a lot of doing good, but people start off with 50,000, and before you know it, the debt's up to 800,000. We've seen scenarios like that, and then we go to the legal practitioners and say, hang on, is this right? And basically say, what you sign is what you're getting. You signed up to it. So really, there's no chance of getting out of it. Like these guys will keep on pursuing that claim, and you have to concede, because it's before, like previously, you can probably get out of it. Now these days, the paperwork is pretty tight.
And also keep in mind why these people exist. Your Prospers and your Landys and your Moolers and your Fast Rabbits and all these people out there who are offering you what appears to be very fast and on its face fairly cheap money. But understand why they're there. They're there because they're filling a need in the market, which is not just driven by the financial need, but also by emotion. And it's very difficult, I guess, for the psychologists in the room, you'll know, it's very difficult to separate yourself from that emotional state of I need money, I need it now, to step back from that and take some time. And my advice is consistently hasten slowly, and often times don't permit that. But if you've got the ability to have somebody sit there with you, and a significant other, a partner, an accountant, a lawyer, and actually work through it with you before you hit the button that says submit on the application, then the chances of you stepping into a fairly substantial hole are lessened. They're not eliminated, but it's about getting that checks and balances up front to make sure that you're making an appropriate decision.
Just to add to that, no doubt you're looking at these other sources of finance. Sometimes you go to your family to provide funds. Like in this case study, the bank won't provide any funds. So if you go to your family, the key there, when they advance money, is they take a charge. We call it PPSA or a GSA. Bernice will probably explain that a bit better, but it's more taking a charge. So if you advance money, say to your children, and you make sure you take security, like the bank will give you money over your property, they'll take a mortgage. So when you lend money to your kids and other family members, make sure you get a charge because you're in priority. Otherwise, some people, what they do is they go and borrow that short-term funding, but they don't take security. So if things go bad, you become an unsecured creditor. So in this case study, if you're looking for funds to come in, make sure it's documented, there's a loan agreement, and it's sort of, you get security for it.
I'd just like to add in there, from my perspective as a tax advisor, people come to me when they've got a bit of financial difficulty and they say, oh look, just make a payment arrangement with the tax office. I don't know if you realise that the tax office is a very expensive source of funding. They probably charge you double plus what anyone else would charge, and I'd be interested to hear from the other gentleman and Bernice what you sort of think of people using tax offices lending and the sort of problems it can create for you if you make payment arrangements.
I think that, the ATO is the bank of last resort, keeping in mind that it's only borrowing if you pay it back. If you don't, it's called stealing. But it's a challenge because the ATO has all of these sort of residual bits of power that left behind in the 90s when, I don't know if anybody knows in the room, but the ATO doesn't rank at the top of the list. It used to, nearly 30 years ago, but it doesn't anymore. So it ranks with all of the other creditors that you might have in a business or a personal context. The challenge is that they've left these little pieces of sort of financial time bombs in other bits of legislation. So if you enter into a payment arrangement with the ATO, my consistent counsel to people is don't do it unless you can see the horizon. And if you can't see the end of it, don't start it. Because if you start it and it fails and one of us ends up in control of your company, and we have the ability then to go back to the ATO and say, all that money that you got ahead of everybody else, would you please pay it back? And they do. But they then have the ability to come and chase you personally for it in certain circumstances. So you end up paying it twice, which sounds completely, not only abhorrent, but just illogical. But that's the way it works. And there are other scenarios where the ATO, if it gets cranky, can do things which are pretty unpleasant. A director penalty notice is just the start of that. There are things like garnish orders where they can just attack your bank account. They can take security over your personal property. So if you're putting in a payment arrangement and they're not happy with the fundamentals that are going to support it, they can take a mortgage over your house. So all of these things have crept in over the last few years, not necessarily surreptitiously, they're public, but not many people out there in business understand them. So I think it's important to get an understanding of what the risks are in entering into any of these arrangements with the ATO and do it, as others have said, eyes wide open.
Can I just say I've got a question from the floor?
Hi, my first question is about risk management and structuring the business and potentially putting personal property into a company. And so when you're talking about the directive penalty,
Yes, closer.
when you're talking about the directive
No, maybe not.
is it possible to put your personal property into a separate company or a trust? Receive a director's penalty notice or your business is going to administration or have some financial troubles, would your personal property and other assets be protected under
The lawyer.
legislation?
Legal question.
I'm happy to take this one. Depends.
We'd like a bunch of anonymous stuff.
I know, depends.
Left hand one.
So if you're in financial distress, if somebody's coming in, if an external administrator, and when I say external administrator, I mean an administrator, they talk about voluntary administration, a liquidator, a receiver. They're all banded under this one term, external administrator. They will look at all the circumstances as to how your property got to be away from the debtor company. So for example, there are things called voidable transactions, and I don't know if you've heard of preference payments, unreasonable director-related transactions, basically transactions to get money away and property away from that distressed company. If those transactions to move the assets away happen within a certain period of time, they can be clawed back. Same with if you set an asset up away from the company once upon a time, but it's actually that company funding the asset purchase, we could go, or it's possible to go on a tracing exercise and trace the source of funds that bought that asset and bring it back. So if you're going to do that, set assets up away, and it happens a lot, and it's a good strategy and it's a good thing to do. My advice is, if you do it cleanly, and you keep those entities very separate, and including the way they operate between each other. Lots of times there are different companies or different entities set up in this structure, and it all gets loose in how they're operated. There's one bank account, for example, and everything comes and goes from it. There's no paperwork between the entities about trading between them, or the movement of money or assets between them. And it's this red hot mess. If it gets into trouble, that just piques the interest of my fellow panellists, and they start looking at, well, can we grab it all back, all the things back, and put it all back into this one company? So in really long answer, I think the answer is yes, you can do it, but you need to stick to it and be disciplined about how you do it. And that includes the accounting, and I'm sure Gail will have some things to say about this. We've seen a lot of accountants who mop up at the end and just, shovel a lot of journal entries through to separate it, and it's all just a bad look.
Well, there's another question. Can someone take the mic to answer?
I think that answered both of my questions. I was interested also what a director penalty notice is and what the implications are around one of those.
Okay, well, I'll start with
They're bad. Is that enough? No. Look, this really quickly, because it gets kind of technical. There's two types. If you've done all your lodgements and you just haven't paid, then the ATO might issue you the type 1, which says you've got 21 days to pay this amount, or enter into a payment arrangement, or put your company into administration or liquidation. Now, the terms that Bernice just explained a moment ago are used interchangeably by the media a lot. They mean different things, and they have different processes attached to them. But in simple terms, that's director penalty notice type 1. The second one, a type 2, or what's called a lockdown director penalty notice, means that you don't have anywhere to go. If you get it, the debt is yours as a director as well as the company's. It's not a substitution. It's together. And the ATO will go both at the same time if it chooses to. But avoiding that and avoiding the circumstances of generating those things. So my advice is make sure your lodgements are up to date. Even if you can't pay, lodge the document so the ATO knows what the number is. It's a lot easier to negotiate from a position of certainty about the number than worrying if you're going to get one of those double window-faced envelopes in the mail. We all know what they are. We've all seen them. It's going to have a return address of Penrith or Albury in the top left-hand corner. You don't want to be getting those unless they're just statements.
Could I just add, out of interest, I read yesterday that since the ATO have started on their most recent attack on tax office debt, they have raised $2 billion in the last, I can't remember what short of time it was, from directors' penalty notices.
And they're issuing 80,000.
Yeah.
So 80,000. They've issued 80,000 reminders, and they're issuing 500 a day or something like that.
Yeah, I don't think it's 500 a day, but it's it's a ridiculous ramp up. Yeah.
Anton.
As someone who's gone through difficult times and had to deal with challenges and loss, one of the key factors that I found was to my benefit, and also that I found as a business advisor with businesses that go through difficult times, is often they have a lack of communication with the people that they owe money to. And picking up the phone and talking directly to the person that you owe money to has, whether it be the ATO or anybody else, in my experience, I've found has been the key to be able to get through those difficult times. And how I've explained it to business owners in the past has been, if a mate lent you $20, would you cross over the road if you saw him a week later and you hadn't paid him back his $20? And they go, well, maybe. And I said, but if you walked up to him and said, I know I still owe you $20, as soon as I can pay it back I will, how do you think his reaction's going to be to you rather than see you cross the road? So what's your views on communication with the people that you owe money to?
I think that's a good point, Anton, is just be honest and truthful, because I think once you break that trust and confidence, especially when with the ATO, it's a good example, when you say I'm going to make a $10,000 payment each month and there's something you renege, then you go back 6 months' time and say, okay, I want to do another payment arrangement. And they kind of look at your history and say, hang on, you defaulted the first time, so we'll do it again. So the key is, especially with your key customers and suppliers, if you've got a good relationship and there's a bit of loyalty and there's a bit of business over time, you're in a good position to go to them and say, okay, I'm in this difficult situation. Anybody appreciate it in the last 2 years, especially with COVID, there's a bit of kindness out there in my view. Like, people are not going to be really hard and be ruthless in trying to recover their money. But if you don't if you ignore the emails, the telephone calls, things like that, then they've got the last resort is to basically go to a citizen and say, I've had enough of this, get legal action. So when you come back and try and make an offer, the client is more likely to say, no, I've had enough, I want my money.
110%. What Frank said, and you're absolutely right, Anton, communication. When people come to us and they want debt recovery action, they've had enough, we invariably start by trying to resolve it, settle it, because some money is better than no money. I know that with our own clients. We have a whole bunch of clients who are behind in their bills, and I say, just talk to me about where you're at. Drop me in something and keep talking to me. So that's tapping into that kindness perspective and just good human, character. Just be a decent human being about it. If you owe some money, you catch more flies with honey, right? So just be upfront about it. But for a technical perspective, if you can renegotiate when your debts are due, you're potentially changing the position as to whether your company is insolvent or not. Because some of the indicia about insolvency is, the debts are overdue, you're paying outside of payment terms. If you can put arrangements in place with your creditors, then you have an argument that your payment terms or your trading terms have changed and you're not actually insolvent. That's perfectly fine. And if I was acting for you as a business owner against one of these boys, that's the line we would try and take. But you need to help me to help you by having those conversations and seeing if we can negotiate a different scenario for your business.
Yeah, I'd probably add to that by saying most of you in the room, your engagement with us is far more likely to be on the end of being owed money rather than owing it. And so if you are a creditor and you've got debtors out there, or even vice versa, the value of that communication is immeasurable. If you're chasing payment from people, get on the phone. Have somebody, and not just have an office junior ringing up and saying, can you please pay this week, without any subtlety to that conversation. I think Anton hits on it, and the mate's perspective, and Frank's already mentioned the kindness part. Have some empathy around those conversations. Most people are doing it tough at the minute. There's plenty of things out there going on that are driving up financial pressure. So have those conversations with empathy, but always from the perspective of what your business needs. Remember, charity begins at home. So you're not there to fund other people, and you've got to run your business first. Because if you do end up in a situation where we're looking at what you may have done in your business, your obligation isn't going to be just to your creditors, it's to your company or your business to start with. So I think, have a think about that. And the other thing we do, I guess as practitioners, is we fall into the trap when we communicate with you of knowing what we know. And perhaps sometimes we don't communicate well enough with the people who are looking to us for information. So if you ever have an engagement with us or people who do what we do, never feel as though you can't ask a question. because sometimes we write things in shorthand and leave out some necessary working, and when you come to reading the correspondence we send out, which is normally sort of many pages of these things, and people go, I can't be bothered reading that, what's the real answer? Get on the phone, ask some questions, you'll find that we're very receptive to that sort of communication.
Aaron?
Yeah, and going back to what we spoke of in the restructure side of things initially about how your attitude as a director and as a business owner helps a restructure, just as importantly, formal restructures are a creditor-driven plan. So you put the plan together as the company or the director, but it's ultimately your creditors that decide whether or not they want to accept your plan or not. So if you're on the front foot and you're talking to everybody and everybody knows you're going through a tough time and you're trying to work through it as best you can, they're more likely to support you through that plan. Whereas if they just get a notice you've gone into administration and they haven't heard from you for 3 or 4 months, they're likely just to come and vote to wind you up just for the sake of winding you up versus support you. So it's very important, hugely important.
Thank you. I've got a question over there.
Hello, Siri Bo from the Joyful Food Listener. So, just a question for someone who's not an expert, like when the Medzian has an example, are they actually insolvent? Like if someone came to you with that, like the reds clearly are more, the amounts owed that's gone off the stream, come back, it's clearly just more than agreed. Is it that at that stage where they are actually insolvent and if someone came to you, you would call it at that, or does it come down to their emotional ability to get through that?
If I can start initially, looking at the numbers, say potentially you've got the numbers that I did, you've got the super and employees entitlements, there's probably, we had there 120 and 220 in terms of super and wages, and then you've got supplies. The ATO was 200 plus 95. So potentially they are insolvent, because at the moment they've got 495 grand worth of debt. They're relying on this 500,000. So the test that we apply is, can you pay your debts when they're due and payable? Insolvency is the ability to pay debts as they fall due. So here we are, can they pay their debts when they're up for payment? So there's probably a risk there that they're probably likely to trade insolvent, so that's where you've got to be careful, because you're relying on that 500,000 to come in. In a way, the 500,000 is good because it's coming from the government. You kind of know it's sort of guaranteed from the government, but if it was from a private business, you kind of got a bit of that uncertainty whether you're going to get that money. So when you continue to trade, you've got to make sure you can pay your debts that you incur in the terms of credit.
Yeah, I'd add to that by saying, look, insolvency is one of these scary things, and it has a weird definition in the law, and I won't take you to that. Frank's pretty much covered it. But it is a factual analysis. It's sort of a binary thing. You either are or you are insolvent. The difficulty is, a lot of the time, it's not an endemic thing, it's just temporary. And so the courts have certainly recognised in the cases that have run years gone by, that a temporary cash flow shortage, where you can see the other end of that and you've got cash flow projections that show you can come out of it, is not a terminal insolvency situation. It's where things like this start falling apart. So if the government isn't paying its $500,000, how long for? 1 month, 2 months, 3 months? Where do you get to the point where, on the risk-based decision about what is the likely recovery of that, how much are you writing it down? And then how is it affecting the other bills that you have to pay as and when you have to pay it? So I think from my perspective, looking at the case study, the answer is it depends. And you'll hear that a lot because it depends on what the directors do. So it's not the company paying its debts from the money that it has. It can go and borrow money. The directors can tip in their own personal money to pay debts. So it's not just as simple as saying, all right, assets this, liabilities that, the number is negative, therefore you're insolvent. There's a bit more to it than that. So unhelpfully, my answer is very equivocal. I sit on the fence and it depends.
The other side is that you're not paying the ATO, so you're behind in the ATO and your super, so they're probably the first signs of insolvency. And then secondly, you're not getting money from the bank, that's another sign, so you're behind with your suppliers, and plus the signs are there also that you're on a COD basis with your suppliers as well. So there are certain signs that you potentially are trading while insolvent. But like Tony has said, if you've got other sources, if the directors can inject capital And that's when you go to court and people want to sue you for insolvent trade, they said, do you have an ability to borrow from other sources? If you made a promise to lend money to the company, then that's going to be proven that you were actually going to do that rather than just say you were going to do it. So there's a bit of case law in that you can rely on those sources.
It doesn't help you at all, does it?
It's just really interesting because, your point, because you've got legal obligations, you can't continue to trade and sell it, so at what point do you call it?
Exactly. So I think on the face of it, they are either insolvent or about to become insolvent. I think the answer is they need to investigate whether that's true or not. But by virtue of you raising it and even asking the question and understanding that, you're satisfying your director's duties. You understand your financial position, you've asked a question about it, you're now seeking help. So that's ticking those director duty boxes. As to whether or not you've been trading insolvently, that's down the track, but that is if you're advising people, if you're business owners, this is absolutely where to start. Look at those numbers and then ask more questions.
In this situation, you're probably going to seek protection by appointing a voluntary administrator. So in this situation, you appoint a voluntary administrator to take control of the business. So we continue trading, and you can do a deed of company arrangement where when you get the $500,000 from the government, you can probably offer that to your creditors as a settlement plus a bit more. So that gives you that protection. If you think you can't trade and you believe you're trading insolvently, then the advice may be appoint a voluntary administrator in the short term to sort of get out of this situation.
One other thing that this example highlights, and Gail's done a very good job of sort of articulating the position, but we've all seen businesses, friends of ours who've had businesses where the mad rush of bringing accounts up to date happens right before a BAS is due. And there's no nervous look sideways, but there's value in, we've all heard the analogy of working in your business and working on your business. There's always value in having information at your hands. These two, in our example, can analyse their position or have others help analyse it because they've got information. But if you don't know what the position is, if your management accounts aren't up to date, if you're not keeping your Xero or your Mild or your QuickBooks up to date on a regular basis, then that information that you need to know about am I or am I not insolvent when something else happens is not there for you. And it often takes time to bring that up to speed to work it out. Now, we've all seen businesses that have gone through large external shocks. Hello? Cousin feedback. We've all seen businesses have gone through large external shocks where it's obvious. There's no recovery from that particular financial shock. But some of these things, which, like in this example, are a bit borderline, and maybe there's a way through it, but time is critical. You only can navigate that path and have a plan constructed if you've got the information to start with. So, takeaway number one, keep all of your information up to date.
If I could just add, because obviously Tony pointed out, John, I'll come to you in a moment, I actually wrote this, and I did, thank you, Serena, because I deliberately did it, leaving it as well, maybe they are, maybe they aren't, who knows. So the numbers were picked on that basis. So you actually, from the case study, actually worked out the basis that I was coming from, so that it did allow some discussion. And John, you had a question.
Yeah, can you hear me?
Yeah, fine.
Wayne's coming with the microphone, he's just behind you.
Thank you. I didn't want to leave this morning without giving Frank a question.
My question is on the insolvency. You say that an insolvent company is insolvent if it can't pay debts as and when they're due. The example you've given me tells me that these guys have been insolvent for almost a year. They can't pay the super, well, they couldn't pay the super, they couldn't pay the tax debt, they couldn't pay the suppliers. They are insolvent, there's no question about it. Plus, when you look at the super debt, if you look at the calculations the taxman does, that 100,000 suddenly becomes 250,000. So I don't think the question is correct. Are they insolvent or aren't they? They've been insolvent for years. That's, to me, it's black and white. Is that right, Frank?
I think you're right, John.
I have a question over there, thank you.
Good answer. answer.
Mine is whether if you've got a business that owes $500,000 and they come to your companies for assistance and it's tidied up in a year. I mean, I know there's lots of variables there, but when do you want your money for your services, and what sort of ballpark figure? Is it a 10,000? I know it's hard for you to say, but you've got a business with a husband and wife who own it, owing $500. They trade their way out. They see you guys once a month, or I don't know how often you come and see them. But is that a $10,000 exercise? Is that a $50,000 exercise? And when do you want your money?
Aaron, you want to have a crack at that? You set the time for this one.
Yeah, that's a really good question. I think it's something that people find pretty daunting about insolvency practitioners, and the rumors around, the fees and the costs associated with trying to restructure a business or wind up a business. We do like to get paid, and we do like to get paid up front in certain situations, or in priority to everybody else, is the short answer. But ultimately, a business this size, I think it just depends on the scale and scope of work that you have to do. We charge on an hourly rate basis, so the more work that's done, the more expensive it is. Less work that's done, the cleaner it is, the less expensive it is. On an advisory perspective, we have a lower hourly rate at my firm that we use for advisory pieces of work, and we usually do that on a fixed fee, or a percentage base, or a fixed fee within an hourly rate for additional work on the back end of the initial piece of work. So the informal stuff, we definitely try to lock in a price for that. The liquidation stuff we can quote, and a lot of times we'll quote a fixed amount and ask you for an indemnity or a third-party payment because there's no assets in the business to pay us. They're either secured or they're not there. And then the work that we do will cost more than that, but we won't generally ask you for more of a contribution. So as a director, I think you can kind of peg in a cost as far as an upfront payment goes, but ultimately it might mean that we then chase you down the track for certain transactions or other scenarios where you might have to cough up again later, if that makes sense.
I suppose it's like where the operation was a success, but we lost the patient. So,
yeah, having the patient die on the table is never really a great outcome. Our rates for partners in our practices sort of vary between $500 and $600 an hour, perhaps slightly north of that. In Sydney, they're up around $700 to $800 an hour, and it stops people's hearts when they see charge-out rates in our reports. They go, "Oh my goodness, we don't get that, by the way." And unlike bankruptcy, which is a personal insolvency arrangement where there is a government trustee that does it, there is no government liquidator. So part of the work that the three of us do is sort of a social service in part, and oftentimes we don't get paid at all for the work that we do. There are some jobs where we don't get a look inside the tent before we start, and often they're ones where Bernice might be involved in helping a client wind up a company, and we've said, yeah, we'll do the job for you, and we just don't know. Part of what we look to do is try and maximise that pool of funds that are available in a winding up or an administration, because it helps us to get paid. We get paid out of the assets of the company generally, if we're talking about a corporate administration or liquidation. And so, aside from any upfront money we might have, which are generally small, except in rather large matters where there might be a bank that's funding something. But generally speaking, mum and dad type stuff, it's small dollars, and we get paid, if we get paid, out of the assets of the company. So we tend not to try to come back and say, can we have some more please, can we have some more please? But there is this perception that liquidators' first statement is, open your wallet and say after me, help yourself. We try and not work that way as much as possible, and if we can give you certainty around cost, then that helps with any restructure certainly, but it helps with planning for the outcome of what people might get.
Probably in this case study, like if somebody approached us and say, okay, with this scenario, I want to look at this, we would normally probably say $10,000 to do this probably pre-insolvency advice. So what we would say, these are your options, okay, this is what it looks like. Option one is negotiate with the ATO, or option two is sell the business, or or the other one is what does a liquidation look like? What does a voluntary? So there's a report that's prepared that gives you the options, all the scenarios. So what's the implication of going to liquidation? Going to liquidation, okay, if I've got a lease, what happens? I've got 5 years to go on the lease. I'm not personally liable for that. I've got the bank involved. You know, if I don't pay the bank, is my house at risk? So you get this kind of detailed report that gives you informed decisions, so you can make a proper decision. So, and normally in this scenario, it would be about $10,000 that you probably ask for.
Thank you.
Okay, there's a question up there. I can't see who it is. Is that Leanne?
Hi, it's Leanne. Yeah. Hi. There's a lot of doom and gloom in the room, and there's a lot of doom and gloom out there. We're talking about direct notices being delivered at the rate of $500 a day, a week or whatever. What I would like each of you to think about, and this is my question, is if you're advising startup people, new business owners, and there's a lot, because people after COVID, this is a great resignation and starting up new businesses. For each of you sitting up there, and that includes you, Gail, what would you think would be the one best piece of advice you could give to avoid getting into this kind of a mess to a new business owner?
I'll be really quick because I've been long all morning. Plan for the end at the start. I'll expand. Sorry, I can't help myself. There are so many startups out there which start off with an emotion and a good idea and people coming together to try and build an enterprise. And what I often see, and what I guess some lawyers, and Bernice can speak to this, will often see is they forget about how they're going to stop doing what they're doing. Particularly younger people, they're not going to be in business forever. So how do you get out of that? And what does it look like? And what's the process? And you know, certainly Aaron and I have been in different firms and left different firms, and those firms have structures and processes for how you come in and how you go out. And it's just as important in a startup is understanding what is the mechanism. It's a bit like a marriage where you go in with a binding financial agreement and it says if we leave each other, these towels are mine and those towels are yours. And you don't want an argument over whose towel is whose.
So what you're saying is succession planning, basically, from stuff.
Or maybe not. Maybe the business isn't something that succeeds you. Maybe it's a sale. Maybe you're building this up as an entrepreneur and you're gearing it as a takeover target or something that somebody bigger than you can buy. Maybe you're going to have one partner who's younger and one who's older, and the older one has a retirement plan. And they're not going to be there forever. So how does that person's interest get acquired by either somebody else or by the existing players? So it depends on your circumstances, but it's really important to have that in your mind is how does this end for us and not have to cost us a whole bunch of money? Because we all play in the dispute space as well. And there's nothing that will bring an enterprise to a grinding halt faster than a good, healthy barnyard dispute.
So what you're saying is actually see a lawyer and set it up before you start.
Yep.
Thank you.
We're running out of time, people, so if we could... No, you can keep going, but just we could have short answers.
Sorry.
Please. No. Oh, it wasn't intended for you, Tony.
No, it's I'll take it anyway.
You're right. See a lawyer. Money is the root of all evil. I can tell you that after being a commercial litigator for nearly 20 years, it's at the centre of everything. So if you are starting up and you have someone else involved in your business in any way, whether that is a lender or a business partner, please go and see a lawyer. It doesn't have to be a national firm. It doesn't have to be a Mills Oakley. Go and see a good, competent lawyer and get the rules of engagement documented. And that goes to Tony's piece as well when he says plan for the end. What he's talking about is get a partnership agreement, get a shareholder's deed, get a joint venture agreement, get some sort of document that, as I said, sets out the rules of engagement and how you are going to part company, like a prenup. Plenty of people come to see me when it's turned to custard, when they hate each other. They've been in business with their best mate and they had a great idea and they loved each other. Now they hate each other, there's money they're fighting over, and there's no exit strategy. There's no section in the Corporations Act or in any business agreement or legislation that says how people are to break up. So you have to battle it out. You have to negotiate or you have to go to court. And people say to me, I didn't get a shareholders agreement because lawyers are expensive. And I say, well, how's that working out for you now? Right? loving being with you, you know. So please spend, it's like an investment. Invest in your business, get some paperwork in place. The second point I'd just quickly make is get some good advice. Get some good advisors and see them more than once a year. Don't just go and see your accountant to get the tax returns done and then quibble about the price of the number crunching in the form. Go and chat with them, even if it's half yearly, just to check in with them and stay on track. The investment's worth it.
I think my biggest piece of advice would be to be patient. My experience with startups is that people have a good business idea and they start the business and then they see the business going really well and there's a lot of cash in the bank. And it's very tempting to take that out for yourself or overcapitalize on plant and equipment or invest in something that doesn't give you an immediate return. And it's very important, I think, to go through a few business cycles, have some good liquidity in your business and see how, when it moves into its maturity phase, where your profits actually settle, where your operating expenses kind of plateau out and get an understanding of how the business is actually going to run once it's at altitude, and prepare for that in the second or third year versus think it's going to just go gangbusters straight off the bat. Because most startups do go really well initially and then they plateau. And if the cost structure is not right and you don't have liquidity in the business to ride out that kind of plateau point in the business, that's usually when they go under.
Probably reiterate what both panelists have said today. Like probably the other key one is probably documentation. Keep your document books and records up to date so you can make informed decisions. So if there's a bit of a dip in your business, you can react and make changes in terms of operating expenses. And plus the other key is to innovate. So you always got to kind of this idea that your business has been going around for 5 or 10 years or starting up and you have the first 2 good years. You've probably always got to have that innovation mindset and see whether your business is transformational, whether it's sort of keeping up with the time. Especially with COVID, you need to adapt, change your trading hours, the shortage of labour out there. So you've got to kind of always be on your toes and just meet the daily challenges each month, each year, sort of thing.
I was asked to comment, so before we wrap up, I will also just pass comment because I'm the person, the accountant people see all the time, or if they remember to, but it's no use coming to me when you've invested in something and I tell you you can't afford it. It's a bit late. You actually need to engage early. I don't mind, I don't charge for phone calls if someone rings up and says, should I buy a lathe that does so and so? And I say, how much does it cost? And then we have a quick conversation and the decision is made. And there's no charge. That my client, that's part of what we do. But people often don't engage early enough, and then I'm left going, what on earth did you do that for? You know, it's really important to remember I'm a friend. I'll help you, but you just need to pick up the phone. I can't pick up the phone and ring people up and say, oh, is it all going well now for you? Okay, you don't need to talk to me, fine, bye-bye. I haven't got time to do that. So it has to be you, it's your business, so you're the one who needs to engage with me first off. And I'm always happy to help. I mean, obviously we charge for some things, but a quick phone call, I don't bother. It's not. It takes me longer to write it down to charge it than it does to make the call, so I don't bother a lot. So, you know, we're here to help, as everyone says. That's what we're all about. We're all here to help.
And you'll find that most of us, if not all of us, will take initial meetings for free anyway. So we'll give you a certain part of our time, and certainly from my perspective, I hand over an hour of time at least for free, and sometimes more than that. Depends on who I'm talking to and what about. But there are opportunities to get some advice without having to reach into your pocket. And for me, investing some middle capital in startups is a good thing, not a bad thing.
Okay, look, I'd like to say thank you so much to all the panellists. Because I'm sitting, thank you, Peter. We've got a little something for each of you for giving your time today.
Thank you. That's very
so
thank you so much.
Thank you. Please.